Welcome back, everybody. It is Money Monday. So you know what time it is?
It's tool time.
Oh,
with the tool man Ferris and his
the trusty
trusted
sidekick.
advisor. Yeah, what's the other guy's name?
I forgot what that guy's name.
So that's it. Welcome back, everybody. It's Monday, 3:30 Central here on Money Mondays.
All right. So let's get right into this, folks. So today we're talking about sustaining growth in multifamily real estate, right? Strategies for long-term success. So what does that really mean, right? I think you have a lot of folks that get pumped up and they go through a 3-day boot camp, or they're told that they can retire in 5 years. And I think what people need to understand is that you can get rich, but it's over time, right? So it's not a get rich quick scheme; it's a get wealthy over time play, right? And so
Absolutely.
in order to do that, you need to be able to sustain a company for a long enough amount of time so you can actually make some money in this business.
You have to scale it effectively and bring on the right people. Actually, just today I had a conversation with multiple brokers, and we were talking about kind of what's going on in the market and who's having issues and who's not and why, right? And again, in this business, you can build real wealth, but do the right thing, build the right business, grow it effectively.
So what would you say, kind of getting right into this, so some of these questions kind of came in before the show, right? What are some of the key things that I think when you're starting off, or even if people are already in the business, right? What would you say the key to success is and having longevity in this type of business?
I think the biggest thing is you need to be constantly networking all times of the day, right? It's not who you know, what you know, it's about who knows you, right? And really figuring out people that have a
building
problem.
a brand.
Building a brand is an indirect way. So there's really the networking, and then building a brand is a way to leverage that and grow that as well. Yeah. But to me, it's, outside of a brand is one thing, but even just building good, close relationships with people, right? That can be brokers, that can be partners.
Strategic partners,
yeah.
Right? Yeah, I would agree.
To me, the partnership comes first, then the brand is really a way to scale it. That's how I really look at the two.
I think that's
different. So.
You have to have a little bit of track record for people to really take your brand seriously. I know some people go about it, and there's a lot of just fake it till you make it in our business, and I hate that. I get why people have to do that. I get it, right? But if you don't make it, right, then that really kind of tarnishes the syndication, I guess, industry as a whole, right? Absolutely. And that's where you get a lot of these brokers and these lenders, and you get these more institutional guys. And I'm going to be honest, folks, I hate to say it, but it's kind of a running joke in some ways. Some of these firms that have kind of built their brand up or built their name up, and they're just kind of looked at as just like clowns, right? So I think building up those strategic partnerships, those strategic relationships, doing some deals, executing on your business plan at first is huge. Then you have a track record to really fall back on.
And you have partners that you can, you have brokers that will bring you deals. You have partners that you can go take down bigger deals, right? It all starts to tie together. And so it's about getting out there is the biggest part of it, right?
Does that happen overnight?
Yeah, typically. It takes years to build, right? You're constantly evaluating, and sometimes you'll be in favor with certain people and out of favor, right? Maybe they their long-term goals are different, right? You have a person that's ready to partner today, you don't find a deal. A year from now, that person may not be interested. Something has changed for them.
I think that's a good point too, right?
So that's why it's about constantly keeping it fresh.
The people that we partner with today aren't necessarily the people that we partner with in the past, but that doesn't necessarily mean that we're not friends.
Yeah,
we are. I think for the most part, we like all of them.
Yeah.
It's just, they might have gone in a different direction, or they're looking to do something different with their career, right? But I guess the main point that we're trying to make, folks, is when you're starting off, building those key relationships is probably paramount more than anything else that you do, right? And sticking to your word and getting deals done and ultimately hitting those returns, right? Building that track record, I would say, once we started doing full cycle, deals and having exits and far exceeding the returns that we gave to investors, that gave us a ton of momentum, right? And now we slap that on all of our marketing kit.
Absolutely.
Right? But that took time, right? The shortest amount of time that we had between a buy and a sell of a property was 20 months. So you're at least, call it 2 years that you're going to have to suck it up for a little while, right? Before you really get some momentum in this business. That's 2 years, folks. So yeah, maybe you make a little bit of money along the way, but it's going to take some time, right? And to give you guys some perspective, we started Disrupt Equity in 2017, right? It's 2023, right? 6 years. And so, it takes time to build up that momentum and that track record, and then you can leverage that into building a good brand.
And so besides that, right, what else would you say?
I'd say the team.
Yeah.
Team. I mean,
it's find people that can do things better than what you're doing.
Yeah, I mean, it was the me and Ferris show for years, or for at least the first couple years.
Now it's just the Ferris show, and I don't know what this guy does.
Hey, I'm on Monday Mondays, all right? Come on. But bottom line, you have to build the foundation in a way where you can hire on, you can recruit great folks to take you to that next level, right? Because what's going to end up happening, and we've talked about this on the show, right, is you can only do so many things. Right? After 2 or 3 deals, if you're the only person doing everything, or maybe you and another partner, you're going to run out of bandwidth. You're never going to have anything outside of doing the deal and working within the deal. You're never going to be able to find your next acquisition because you're going to be so dang busy. So it's important to build a good, solid foundation, that you can then recruit great people onto. And then you can start offloading and delegating out things that maybe you don't like or you're not good at, or you can find somebody that's better than you, right? And that's the one kind of drawback of being an entrepreneur is you might like and you might be all right at certain things, but I bet you there's somebody out there that's better at it than you are, right? And you have to be able to relinquish that and allow them to go run and thrive within the company that you're building too. So I'd say that, start off doing it how we talked about, but the second phase of longevity is really building the solid foundation with the team, right?
Yeah, getting people that are better at things, because now
absolutely
the problem with early on, you're in this mode of having to do it all, and so you're just constantly 50% of your time putting out fires, 30% of your time kind of figuring out what's next, 20% working on the business. Right.
If that.
So you're not able to give enough attention to any one thing, right? The one that I like to pick on is accounting, right? That's the easiest one for people to constantly ignore, right? Ask us how we know, right? But now we're at this organization, now we're doubling down and trying to do it all the right way. But you can get by for a while, right? Deprioritizing that and just knowing that, hey, it's not going to be clean, it's not going to be sexy or awesome the way it is, but it's good enough, right? And you move forward, right? We have chicken scratch of the math we did for certain things.
We had a spreadsheet.
So we had a spreadsheet. But now you get someone in better that can take it deep, right? And so early on it's about going broad, but then as you grow, you start to be able to get people that can go deep, right? Even the show, right? I mean, it's something that's kind of evolved, and we have a person dedicated now to helping do this or events and, accounting, IT, marketing. All of these are roles that start to mature, right? And so being able to go broad enough, but now, to grow sustainably, we have to go deep and really be the experts at every aspect of the business.
And I would say what I've seen, and we fell somewhat into this trap when we started off, right? Whenever you're starting to get into the multifamily syndication business, or just call it commercial real estate in general, right? The fun, the sexy part of it is underwriting the deals, finding the deals, getting the deal under contract, raising the money, getting it closed, right? Boom, I'm done. Well, you can do that for just all out, year or two, but what's going to end up happening is the asset and the property management is going to be in total chaos behind you, and that stuff will catch up with you, right? So a lot of people fall into that trap, especially when they start off, is they focus 100% of their time and energy on the acquisition part of the process, and then investor relations and acquisitions and just underwriting in general, right? But really what they should also be focusing some time on is how are you going to perform on these, and how are you going to hit those projections that you gave to your investors? And that's where that catches up with people, right? I'm not going to name anybody's name, but you guys have probably seen some people that did a lot in 2021, and you're just like, man, how'd that guy buy so much stuff? Well, he ain't buying as much stuff anymore. And you want to know why? Because all of his stuff is in chaos, right? And now he's having to go back and hire people on and fix all the stuff that he should have fixed from the beginning, right? And we were aware of that starting off, and we've scaled appropriately because of that, right? But everybody kind of gets caught up in the fun stuff, right? But don't forget, to be in this business the long term, it's really where the rubber meets the road is the asset and the property management stuff, right? All right, so moving along. So what are some of the current trends and challenges facing multifamily real estate, and how can investors navigate these to achieve long-term success? Woof. All right, so I would say we've talked about this on the show, right? Debt market, interest rates,
right now the
inflation.
biggest challenge is the debt market,
yes.
Period, across the board.
So you have to have great relationships with lenders and mortgage brokers that are going to be able to help you maneuver your way through this ever-changing landscape of lending, right? And I think that if you can do that and you can smartly, if that's even a word, put the right debt on the right deal, you'll be all right in the long term, right? I always feel that there's deals to be had in every part of the cycle. This is no different, right? We're almost under contract on a 3-pack, and I'm really, really excited about that. But at the end of the day, right, you have to structure the debt properly. So I'd say, and that's in all parts of the cycle, folks, right? Putting the right debt on it and having the right capital stack is important. I'd also say some of the other challenges too that we're seeing, just with friends in the business as well as being a third-party property management company, is that some of these people weren't well capitalized.
Yeah.
Right? So how do you solve that? You got to have some reserves, folks.
Then that ties to, I think the other big challenge is just holding on to deals long enough, right? What does the refi or the forcing function look like for these deals, and can they get it done?
Yeah.
Whether it's a refi or an exit or having to get a new interest cap. I mean, I was talking to a broker today on a deal I need to catch you up on, and that's not the group is deciding on. Do they burn the money and buy another interest cap at the current costs, right? Or did they exit? I mean, it takes we have to bring fresh money in. Unfortunately,
they're balancing that right now, and I think in a lot of ways, people they're gonna start doing those mathematical equations, and they're gonna find out it might just be easier just to sell, right? Because the caps are still really, really expensive, folks. And what an interest rate cap is, look those up. We've talked about it on the show before, right? But I think that's all part of structuring your capital stack correctly and getting the right lending. Again, having the right amount of reserves is key, though. And again, some of this stuff is not necessarily, just because of what's happening right now. That's just throughout whatever cycle you're in. Having the reserves, having that extra $1 million, I'm telling you, do the underwriting. If you don't believe me, yes, it's going to water down returns a little bit, but it's going to make everybody in the whole entire process, the whole entire partnership, sleep a lot better at night, because they're going to know that they got the cash in the bank, that if something pops up, something happens, right, which it has over the last 12 months, that you got the cash in the bank to weather the storm, right? So I think that those two things, getting the right cap stack, having reserves, are probably two of the biggest things.
Yeah, and then
right?
and then maybe the other one is just personnel, right? Management's tough. Finding good employees is tough, right? And it's kind of tight labor market.
Having the right team,
so
right? Again, goes back to team, right? And the team could be your in-house staff, or it could be a third party. A lot of the other challenges that we're seeing, because again, we're on the third-party property management side, is we're mopping up after a lot of these other third-party companies that either scaled too quickly or just really weren't ever doing a great job in the first place. They're making a challenging environment, which is what's happening right now with inflation and interest rates. They're making these deals even worse by just the piss poor way that they manage them.
Absolutely.
Right? So picking a good management company is key to long-term success too, because they are your boots on the ground.
So real quick, Money Mondays are just every Monday, 3:30 Central. If you have comments, questions, thoughts, please ask them. We will answer them here live.
All right, so what role do amenities and services play in the success of multifamily properties, and how can investors prioritize these to attract, retain tenants? I mean, this is kind of not about long-term success, but it kind of is, right? I think in the end, your properties need to perform in order for you to be successful in the business, right?
Yeah, maybe it's about the long term in the sense that the goal really is to build a community.
That's absolutely right.
It takes time to build a community, but in the long term, and making those investments up front gets you a much better quality community, which in turn gets you a better asset and better performing asset.
Yeah, and why do we like to build communities?
I don't know.
You're supposed to have
it makes life. I mean, it makes life easier, right? Those people want to stay and they want to renew. They will tell you whenever there's a poor actor that's doing something, right? That and ultimately it makes the deal so much more operationally easier, right? Yeah. The tenants are happy, the employees are happy because they have happy tenants. I mean, it's just kind of a very, very symbiotic.
So you have when you have families, folks, you have less turnover, so it's going to cost the property less because they're not having to turn the unit every year because some single guy moved out again, right? Because every year you have to replace carpet, you got to do paint. There's certain things that are just going to cost you $2,000 or $3,000 no matter what you do. The other thing too is just from a safety perspective and just a quality of an asset perspective, having kids and having, family friendly amenities, that's all just going to bode well in the long run, right? Because, you're going to have just better people that are going to want to be there, right? Even if they are single, I would much rather probably be in a community that's more family friendly and has that type of, community feel than be in something that, I don't know, there's just a bunch of bachelor guys and gals, and it's just it's a free for all, right? And you gotta think of it in terms of longevity of your tenants too, right? And the longer folks that stay in there, that is a testament to how well you're doing at the property, right? Because if you're doing a crappy job, they're going to move out at the renewal every single time, right? And it's just going to cost you more money. So building a community is key in this business, right? And I think that's just the right thing to do. It doesn't matter if you're going to be in it for 20 years or 5. We talked about financing options, right? And I think one of the other things too, to maybe make it a little bit less risky, not less risky, lower risk, right? I don't think anything, that we're talking about these days is really even that high a risk, but your loan to value or your loan to cost these days, right? Whereas back in the day when we started off in 2015 and 16, you could get up to 80% loan to cost, folks. Now, what's loan to cost? That means you get your purchase price, you get your rehab, and you get your closing costs, and you get 80% of that, right? That's quite a good loan. You're not getting anywhere close to that anymore, right? And so really where you're seeing that kind of shake out at is probably closer to 50-55, especially on a loan to cost basis. So that's fairly low leverage. What does that mean? You have to bring more equity to the table, right? But you're still in a better spot, especially if valuations are going to fluctuate, especially over the next 12 to 18 months. Some things are going to go down, some things might stay flat, some things might go up a little bit, right? But let's be honest, if cap rates are expanding because interest rates are getting higher, that means values are going down. It's an inverse thing, right? So, again, going back to the earlier statement of structuring your capital stack correctly, and really doesn't really matter if you want to do it this way these days. The only thing that the best debt you're probably going to get right now is 60%. So just take that into consideration when you're looking at deals. If you get higher than that, good job, you got lucky. So I would say that financing is huge in being just able to sustain yourself, because you don't want to burn your bridges with a bunch of these lenders either. The word gets out. You get a tarnished brand with these lenders. They're going to find out about it, and they ask you on every single application: have you ever defaulted? Have you ever had a foreclosure? Have you ever been behind? Have you ever had to do a workout with your lender? They ask you these questions on every single lender application. So even if you didn't mean to and it just happened, the market turned on you, just know that's going to be a scarlet letter you're going to have to carry with you for a little while.
Absolutely.
All right. So what are some of the emerging opportunities facing multifamily?
I think the big one is ultimately about how much can you digitize of the process, right? And specifically around, there's all this talk about leasing and not leading a leasing person that can be done online versus not, right? We look at it ultimately as a company that, hey, that leasing person is there to provide kind of a
customer service.
Yeah, customer service. That person is still needed, even if you could take off some of their responsibilities,
huge,
right? Because that, again, tenants don't have a lot of continuity with the staff. So the more you can provide a higher level service, the better.
Yeah.
And so I think that's probably one of the big ones, right? I mean, then there's obviously,
I think there's automation, like tech.
Like
at
the whole. How far
level.
does it go? Luckily, people still need to leave until we have the Matrix world where you have just a wall of bodies that plug into a computer.
Awesome. I'm hoping that doesn't
luckily
happen.
people still need space, right, for the near future, and so that. You can't automate.
We haven't started living in our pods yet,
yeah.
So we're good. No, but I would agree that there was that push during COVID, right? To try to automate the whole entire leasing process. It just doesn't work, right? Whenever you're looking for a property, you want to go talk to a human being. You want to be in person. You want to ask questions, and some of that can be done online, and some of it can be done through this, kind of more clever technologies. But it's nice to go in and ask questions and feel comfortable about the property, right? And I think there's a lot of value in having that leasing staff. Now, taking some of the minutia, some of that paperwork stuff off of their plate, we're absolutely automating all that, right? The leasing and all that other stuff. But having a smiling face that greets you, that's important. Right, but I'd also say, again, going back to the unit level, there's a lot of just technology and automation that's happening, right? Whether it be you can now open up your phone, you can open up your door with your phone, and you can get into the fitness center with your phone through an app, right? And then you've got smart home automation stuff, right, where you can control your AC and your lights through an app.
And to me, those aren't really challenges; those are the opportunities, right?
Those are opportunities, right? And I think it wasn't that it was like a huge issue. Oh gosh, I got to go to my AC and I got to toggle it or whatever, right? But that's just kind of the way the world's going, and I think everything's going to be app based. And a lot of it's just going to be, you can pretty much live your life through your phone, right? And I think that property management and multifamily is no different than that, right? So I think that those are opportunities, right? And I just think that, technology, on the investment side and recruiting investors and how you go through that whole entire process. That's what's amazing since 2015. What I've seen between the investor platforms and all this other stuff has completely revolutionized how I raise money. It used to be real old school, folks.
Oh, Ben likes to do it old school, and I'm like, every time he's like, my investors aren't used to that. I'm like, which investors? For 5 years ago, they're not even the same guys.
Yes, they're
different.
A couple,
so we can keep on, changing the expectation of whether it's how we do things, what process, what systems, what return profile, all of that.
I mean, I think,
my investors, that phrase, if you catch yourself saying that, you too included, right? Pause and say, does it actually mean anything?
It might not. But I guess, and I'm using this as there's a huge difference between 2015 and 2023, right? And I think it's all been good. It's all for the better, right? It makes it easier to keep up with the process. It's more secure. It's more streamlined, right? There used to be a time when you were emailing a lot of documents back and forth. That is not great, especially with the wire fraud and everything else that we've got going on these days. Having a secure platform is huge, right? So from a syndication standpoint, I think those are all great steps forward that we're seeing in our business, right? But some of those, that's just some of them. Drop your comments in the chat and say, hey, what about this or what about that? We want this to be more interactive, right? So, but those are just some of the ones that we think that you can be more successful on a long-term basis if you kind of stick to those kind of, those talking points, right?
Absolutely.
But what's coming up, buddy?
Multifamily Investor Network on the West Coast, right? We do 3 of these a year. This is our West Coast rendition. It's going to be in San Francisco, lovely city of San Francisco, at a good time of the year in August.
Oh, yeah.
It'll be hot during the day and cold at night. That's typically.
It's not going to be too hot.
No, I've been in San Francisco in August, and it definitely on a sunny day, it gets like kind of, not muggy, but hot. Like sun beating it. No, it'll hit 90s.
It doesn't hit 90
Maybe
in
not,
San Francisco
but it's dry
in
90,
August.
so it feels like it.
Yeah, maybe. All right. But it's going to be fun. You're going to have 400 plus attendees. We're going to have some great panels. We're going to do some great presentations. Ultimately, folks, it's a one-day event. We have networking on Friday. We have networking on Saturday as well, right? But, it's an opportunity to reconnect with some people that maybe you haven't seen in a while, maybe make some new connections, right? Again, it's a relationship business, folks. So we manicure the whole entire event to encourage networking. We're not those guys that are going to berate you for being in the hallway. We might give you a little bit of a stink eye sometimes. But
hottest day ever was 98 degrees September of last year.
90. Well, that was September.
Yeah, but that was also the record. not common.
But anyway, so register today, mfinvestornetwork.com. Throw in coupon code DISRUPT. I think you should probably get some money off. We still got some tickets. We're getting close on the VIPs, but at the end of the day, we've got plenty of those executive tickets left, and we'd love to see you out there. San Francisco, California, August 5th, coming up in a few months. Multifamily Investor Network. But what is happening next week, my friend?
We are talking about the power of networking and multifamily real estate investing.
Building those relationships.
What we started this one off with, right? Kind of that value and kind of what that looks like.
Yeah, it's all about relationships. So tune in next week, folks, and we'll see you then for another Money Mondays.
All right, sir. See you next time.